Welcome everyone to Best Interest. This is Shane, and today we're going to look at one out of the industrial sector. This was actually a suggestion from Justin. We're going to look at UPS. This is the vested interest stock screener. This is the criteria we will be going through in the video. It is not a company out of the financial sector, so we will not be looking at price to book, and it must meet 5 of 8 to make it onto my watch list. Now, if it does make it onto my watch list, that does not necessarily mean I am buying. It just means out of the thousands of stocks out there, I am interested in taking a little bit more time, doing a deep dive into the financials of the company, looking at their balance sheet, their income statement, stuff like their debt to equity ratios. Is their revenue expanding? Is their margins expanding? Looking at their PEG ratio, price to book, some other criteria. That are they paying down debt? Some other criteria that I like to look at, EBITDA, for example. And then if it meets some other criteria that I have, once it makes it past my screener and is in the price range I set based on a discounted cash flow analysis, maybe I add it if I'm looking to add a new position to the portfolio. So don't just blindly buy if it makes it onto my watch list, and don't blindly buy anything that I or anyone else on YouTube or any other channel out there. There's lots of social media out there is buying. Now back to UPS, www.ups.com. That's www.ups.com. That is their homepage where I pulled this information from. And you're probably well aware of this company. You may have received some packages that were shipped, and UPS is the deliverer of those packages. They are a logistics company. They ship packages all over the country and the world. It all started with $100 in 1907. Two teenage entrepreneurs created what would become the world's largest package delivery service. That's what they're still doing today. Starting in a Seattle basement with a $100 loan, Claude Ryan and Jimmy Casey opened the American Messenger Company, today known as UPS. Now, the reason we're taking a look at them, down 0.38% on the day. Like I said, also a suggestion by Justin there. Closed out the day at $86.51. We are talking about United Parcel Services, ticker UPS, out of the industrial sector. 52-week range as low as $84.28, as high as $145.01 there. Definitely closer to their 52-week low than their 52-week high, and actually right up against it, well within 15% of that 52-week low. Market cap of $73.323 billion, a beta of 1.10, a price to earnings ratio, PE ratio at $12.87 per share. EPS is at $6.72 per share. Earnings date coming sometime, or it looks like coming October 28th, so sometime next month. Sometimes they are within a day of that, but October 28th, look out for that if you're interested in this company. Forward dividend is $6.56. Divide by 4 because they are a quarterly payer, though we'll see that here towards the end if you don't want to do the math. Current yield, a very high starting dividend yield, 7.41% right now. Ex-dividend date, August 18th. That was today. So part of the drop looks like it was probably because of the ex-dividend date. 1-year target estimate, $104.63, which doesn't put them quite, not even close to their 52-week high, $145. So about $41 and some change off of their 52-week high, but some upside from where it currently is, again, at least according to Yahoo Finance. Jumping over to the right, I would like to look at dividend yield theory to see if the company is potentially undervalued. It is just a quick check. It is not the end-all, be-all. It is not a discounted cash flow analysis. It doesn't require much math or any math, really. All you do is you look at the 5-year dividend yield average of 3.62%. You compare it to the current 7.41%. Over here, forward annual dividend yield 7.41%, same number. Since it is higher than their 5-year average and almost twice as high, that speaks to, actually a little over twice as high, that speaks to undervaluation, at least according to dividend yield theory. But look at the payout ratio, 97.32%. So the payout ratio is well above the 75% that I'm looking for there. And it leads me to believe they may be in danger if this continues for any length of time. They may be in danger of a dividend cut. So you want to watch that. Anytime the payout ratio, in my opinion, I use 75%. Maybe yours is 70, maybe it's 65, whatever it is. My payout ratio above that, I start to worry, is the company in danger of a dividend cut? Do they have money to continue to pay down debt, make acquisitions, reinvest back into the company, buy back shares, raise the dividend over time, all the things a company can do with free cash flow, even keep some of that free cash flow on the balance sheet in case there's a downturn in the market, right? What if things slow down? They don't have much room to play here. That's what leads me to believe this one may be, again, if this payout ratio remains elevated for any length of time, may be in danger of dividend cut. Now, since we Talked about what companies can do with that free cash flow. Let's take a look at it. Going back to December 2022 here, 9.3 billion, 2023, 5 billion. So drop there. 2024 back up to 6.2, trailing 12 months 3.59. Now let's look at repurchase of shares. 3.5 billion in 2022. 2023 that was down. So not only did they decrease their free cash flow, but they decreased their repurchase of shares to 2.2 billion. And then 2024 just because their free cash flow went up, that does not necessarily paint the entire story because they dropped their repurchase of shares significantly to only 500 million. So it made the free cash flow look like it went up, but really, if you look at the repurchase of shares and how much they decreased that, it doesn't look like their free cash flow actually went up. And it looks like they're continuing the trend of repurchasing shares, 1.5 billion in the trailing 12 months. But remember, we're in August, so it still does include part of 2024 numbers. But every day and every month that goes by, week that goes by, even more and more of those numbers are from 2025. Now, jumping over to stockanalysis.com, 18 analysts have taken a look at this. They call it consensus buy, low estimate of $75. It would need to drop 13.3% lower from where it currently sits to hit that low estimate. Average estimate of $112.11. That would represent a 29.59% increase from where it currently sits. And if it happened to hit that high estimate, and that's a little bit higher, that 112.11 is a little bit higher than what we saw with the 104 and some change projection from Yahoo Finance on the previous page. They happen to hit their high estimate of $147. That would be above their 52-week high, set a new 52-week high, and that would be a 69.29% potential upside. Now, looking at some statistics, I like to look at return on capital employed. I like 10% or better here. They're sitting at 13.87%, so beats the metric that I'm looking for there for return on capital employed. And EPS growth, I like 5% or better projected over the next 5 years. They're sitting at 10.07% with revenue growth forecasted at 2.58%. Now, as we mentioned, quarterly payout ratio elevated 97.41%. Now, they are still raising that dividend 0.61%, but I question whether they should be with such a high payout ratio. You really have to look at their debt to see if it makes sense. Are they, really in debt? Should they be paying down debt? Should they cut this dividend to pay down some of that debt? There's a lot of other metrics you should be looking at besides just the ones on the initial screener, but this is just an initial screener. Growth in years 15, buyback yield is positive, so they are pulling more shares out of the market than they are issuing at 0.58%. Shareholder yield is positive 8.12%. They do pay out like most companies on the March, May, September, December timeframe. Going back to February 2023, $1.62 in dividends. They raised that up in February 2024 to $1.63. Raised that up February 2025 up to $1.64. That's where they've continued it to date, and I would anticipate if they are going to raise the dividend, it will be again in February of 2026 that you see the next one. All right, let's run them through the screener. Understand the business. Again, this is a shipping company. You may receive package from them, though more and more of the shipping from companies like Amazon is done by the company itself. FedEx is another competitor. So they do have some competitors out there, regular mail, but understand the business. Yes, again, they're a shipping company. Logistics company. Growing free cash flow? No. A bit of up and down. Growing dividend? Yes. Very slow growth, under 1%. So, you can call it growth, though. Technically, it is growth. Dividend payout ratio is not under 75%, so no check there. Dividend yield theory says they're potentially undervalued, but is that because they are having issues and the price is reflecting those issues? It is within 15% of a 52-week low, so check there. Return on capital employed is 10%, so check there. Earnings per share growth is above 5%, so check there. You're looking at 1, 2, 3, 4, 5, 6 out of 8. I believe this one may still be on my watch list. I may have taken it off my watch list. I looked at this one a while back and put it on there. I believe some of the things I was concerned with was the debt, but it's been a while since I've taken a look at this. Might be worth taking some time, and I will do some digging into the financials of this company, their balance sheet, their income statement, see what's going on there. And I know that one of the issues that they were having, at least maybe it was last year or the year before, was because of some increased rates in their pay for their drivers because they are a union company. So you have to keep that in mind as well. I think it's every 3 years. Is it every 3 years that they have a renew the negotiations for rates for their drivers, for their union employees? So you have to keep that in mind as well. It's not like they're a non-union company where they can pay a little lower rates. They are driven by the union for what they have to pay. So it does make that on my watch list. Let me know what you think of UPS in the comment section down below. Is it a buy in your opinion, a hold, a sell? Is it one you are selling? Maybe you're part of the reason for the downturn today. Maybe you're buying the dip, and if you are buying the dip, let me know why. Would love to hear from you down below in the comment section. All right, that's really it for this one. As always, appreciate you stopping by. If you haven't done so already, don't forget to show me some love. Hit that thumbs up, ring the notification bell. Most importantly, subscribe to the channel. Join us on this journey of financial freedom. Join the vested interest community. Drop a comment down below. Let me know what you think of the video. Let me know what you think of UPS. All of those things don't cost you a thing, and it really does help out the channel. So don't forget to hit all those buttons down there. I do personally read and respond to the comments. I am always interested to read your questions, opinions, or suggestions for future topic like this one. And thank you, Justin, for the suggestion. I do cover those on a day they pull back. So if you have a company that pays a dividend you'd like me to cover, go ahead and drop it down there and I'll work it in on the day it pulls back and add it to the rotation. This is Shane signing off, wishing peace and prosperity to you and yours. And remember, financial security comes to those who take a vested interest. Hey, thanks for stopping by. Thanks for tuning in. Hope you have a great week, and we will see you in the next one. Yeah, I'm not a financial advisor. You can read the rest of this. Thanks for watching. For those of you who made it to the end, don't forget to hit all those buttons down below. Really appreciate everyone's time. We'll see you in the next one.